Good morning, everybody. Welcome to the budget event for the budget that happened on Wednesday this week. Bit different to normal. I get the honour of doing the welcome to you all. Warren is, unfortunately for us, but he's in Dublin this week on a conference. The budget was a bit earlier than expected. So he assures us he's on business rather than on Guinness, but we'll wait to see when he comes back on Monday. Before we get started, I'd like to just acknowledge that it's International Women's Day today, a day that celebrates women's achievements, a day that raises awareness of discrimination, and a day that aims to drive gender parity. I think it's very important to recognise this, and PEM are, excuse me, sorry, let me get some more. Yeah, I'm very pleased to support this initiative. The tax team is very diverse in its nature, and we're very pleased that over half of the partners here at PEM are female, and over half of the tax partners are female. Indeed, Chancellor is the chair for the ship. Sorry, sorry, my throat. Right. Anyway, onto the budget, and that's what we're here to discuss. When we thought about whether there's a plan for what the theme of this budget event was going to be, we thought, well, is there really a plan? The Chancellor was very keen to explain what he was going to do, and there was quite a lot of hostility coming from the other side. But actually, he constantly went back to the opposition because there is no plan from you. But overnight, actually, there's quite a lot of discussion on the unravelling. Unravelling, the spending plans are unravelling as we speak. There's a bit more discussion on who's benefiting from the budget. Pensioners are perhaps not benefiting, whereas workers are. A lot of the press release was about the a lot of the budget was released in the press beforehand. So there was no rabbits out of the hat on Wednesday. The reduction in national insurance was trailblazed in the days and weeks beforehand. So we all knew what was coming, which was quite interesting because a chancellor back from 1947, a chap called Hugh Dalton, resigned or was forced to leave his office as chancellor because he made a off-the-cuff comment to a journalist as he went to discuss his budget, went to deliver his budget, which then hit the newspapers that evening, had an impact on stock markets. So he was no longer chancellor. Whether that would ever happen now, because we're all released beforehand, I suspect not. One thing that was actually interesting by its absence was no mention of fiscal drag. So tax allowances are frozen and have been frozen since 2021. They're conspicuous by their absence, so they're going to be with us a lot. So whilst we get the reduction in national insurance, actually that fiscal drag is going to be here for quite a while. I've read a couple of times over the last couple of days that the Chancellor has been referred to as the fiscal drag queen, which I think is a moniker that may be here to stay, particularly as this theme is going to be discussed with the budget, with the election that's forthcoming. It may not be the last time that we see the Chancellor at the dispatch box. The current betting is that the election may well be in the autumn. That's the highest, the better, the lowest odds at the moment. There was a talk that potentially the budget may be in May, but I think it's too soon. It just has no fiscal headroom to do much in this budget for the pre-election giveaway that we thought may have been the case. So we could see an autumn statement, which time will there be more headroom for income tax cuts. Indeed, Rishi Sunak said when he was campaigning to be leader before the ill-fated Liz Truss era, he wanted to reduce income tax by 4% over the course of his tenure. And in his last budget as Chancellor, he did say that he wanted to reduce the income tax by 1% from this April. Clearly not sufficient headroom at the moment. It was great to see quite a lot of discussion on Cambridge. Actually, there was a 38-page document released as part of the budget, which tells us what we know all about the great and good of living in a wonderful city. The plan is for Cambridge to be the science capital of Europe by 2050, which is fantastic. And but it is constrained by infrastructure, by housing, by lab space, and by the water and delivering of that to new houses. So that's part of the spending review that will happen in the next few weeks, that Cambridge and the Cambridge Future Fund will have funding delivered to it as part of this process. I suspect for those of you that drive into Cambridge like I do, will be stuck in traffic jams for a long time yet. And this, by the time 2050 comes here, we probably won't even be driving into Cambridge anyway. There's also funding for the biomedical campus of 10 million to deliver on that pledge by the Chancellor. From an employment tax perspective, there was nothing in the budget, which is why I get the honour of doing the introduction. It was probably the opposite of Super Tuesday in America. It was a really uninspiring Wednesday. But the benefit of PEM is that we have lots of experts. So we could make a last-minute change to the team sheet and bring in those people that could talk about the particular aspects of the budget that make a difference to you and are of interest. So our panel today, I would like to introduce Angus Wood, who will be discussing business tax aspects, Stephen Bartlett-Rawlings, who will be discussing non-dom tax changes and inheritance tax, and then Sandra Norris, who will be discussing all of the things related to personal tax matters. You'll see on sort of the slides that there's a QR code, and actually it was the front slide as you came in. Feel free to scan that as we go. It takes you to Slido, which is a sort of Q&A website. So you can raise questions, and we've got a question and answer session at the end of today. Rest assured that the panel will realise that if you do put your phone up mid-talk, it won't be to take a picture of them. So they understand that's going to happen. So without further ado, may I introduce Angus to the stage.
Morning, everybody. So, exactly as the slide says, my name is Angus. I'm a director in the business tax team, and we'll move on. So, corporate tax. Normally, the budget's a bit like Christmas Day for us tax people. Lots of exciting things that we can go out and advise on. But the reality was, save for one very exciting, game-changing VAT announcement, it was very quiet. So I thought, well, what am I going to talk about? Thankfully, we did have an autumn statement back in the autumn, which had some more interesting things that are sort of coming to light now that hopefully I can waste your time talking about. So really covering off, first of all, core corporation tax. So we are now in our first full year of our increased 25% main rate of corporation tax, significant jump up from 19% that we're all enjoying for the last couple of years. We still do have this small profit rate for 19% for people with profits under £50,000, but this does leave some rather complicated tax workings if your profit sits between these limits of 50,000, 250,000, where the effective tax rate is actually starting to get quite high, 26.5%. So this does actually provide a bit of planning for us tax folk, particularly if you have a group of companies where we can try to facilitate moving of profits around using group relief to try and bring the tax down. So at least it gives us something to do. We've also seen expansion of what we classify as a group for this purpose. So we have to think about that. Once again, more work for us, which is good. More things like this. So where are we sitting? This is the list of all the G20 countries. Now I've moved us as far left as we can, but the reality is we're sort of sitting in the middle of the G20. Although looking at some of the countries we've got to the left, Russia, I think I'd rather stay here. Now, are we competitive? Well, I think we are. Yes, we have a corporation tax rate of 25%, but this is really only telling half of the story. We've also got very generous capital allowances regimes, R&D tax regimes. We have our patent box. We've got things like the substantial shareholding exemption to try and clear off any gains that might arise. So the reality is actually we are still a very competitive country in the tax landscape, which I think is quite key, particularly following Brexit, where we're now standing on our own 2 feet and we have to try and encourage investment into the UK. So coming on to capital allowances. So we had one announcement, which is basically confirming that full expensing is to become permanent, which no new news for us there. But they have also realized that there is a slight issue with the full expensing. The fact that it doesn't apply to people who are leasing assets, which sort of covers situations where you might have a group of companies where one company holds all the assets and then it leases all those to another company within the group that actually deals with those assets. So you see this typically with things like civil engineering. And they're caught. So the government has stepped forward and said, it's okay, we are going to consider changing the rules for expensing to bring in companies that lease when the fiscal conditions allow. That's about as uncommittal as my wife working out what we're going to be having for dinner. The reality is, though, full expensing is really only going to come into play for you if your capex spend is going to be over $1 million in a year, because we also have something called the annual investment allowance, which does exactly the same as this. In fact, it does a little bit better because all your expenditure will be covered for 100% writing down allowance, not just your main pool plant machinery. And it provides a slightly nicer outcome when you come to sell. So really, capital allowances, nothing really new there. R&D tax relief, however, I admit this wasn't really actually announced at the budget, but there's quite a lot of it was announced in the autumn statement, and I'm an R&D person, so I like to talk about this. So what we have now seen is the merger of our 2 schemes into one scheme and another one. And what we have seen is our SME scheme and our RDEX scheme merge into one RDEX scheme. And then the separate scheme for what we call a loss-making R&D intensive company, where that will continue to follow the old rules of allowing additional deductions. We were expecting to see the removal of claims for overseas subcontractors and external workers at the same time. But there's been a slight problem. I think HMRC have realized that when they released the draft legislation that there's a few things that needed to be ironed out. For example, when we talk about loss-making R&D intensive companies, well, what is a loss-making company? Do we take that before or after we factor in R&D? I don't think HMRC know this. So rather than saying we're going to bring this in from the 1st of April 2024, which is what we all thought was going to happen, they said we're going to bring this in from the appointed date. And do you think we have an appointed date yet? No. So here's a nice little diagram to show you what's going on. So as you can sort of see, we've actually seen the impact of the SME scheme coming down significantly over the last few years, whilst the RDEX scheme, which is actually one of the large companies, your AstraZeneca's, has been improving. And what we've seen is them trying to sort of merge the two into one line. Now, 2 observations about this. So the first one is, well, I thought the idea was that they're trying to encourage innovation. They want to make the UK the next Silicon Valley. So why have they brought the value of this down? Well, what I suppose you don't see in the tax rules is everything else that the government have been doing. And they have been increasing the amount of money that's available for grant funding. So there's lots more competitions running in the areas of technology that they want to see improvements in. So we see lots more in sort of green technology, advanced manufacturing. So perhaps this provides an opportunity that if you are out there trying to find money and you know that you're not going to be qualifying for this sort of higher level of the purple one, which is your R&D intensive companies, maybe consider bringing in the services of someone to help you apply for grant funding, because there's more money out there and ultimately, it's far more rewarding, the R&D tax relief schemes, because you get your money up front, which is nice, and you don't have HMRC on your back years later saying, oh, I don't think we should have given you that. The second observation is the fact that we've got this little gap in the middle between our nice thick blue line and our orange line. So this is where our SME companies at the moment can benefit more than our RDEC companies before we all merge into one. Now, if you're spending £100,000, that difference, as it says here, is £3,600, so not very significant. But if you're going to be spending £1 million, 30,600 sounds a little bit more interesting. So here's a planning opportunity. Once we know the kickoff date for the merger of the two schemes, it might be worth thinking about moving your year end. The reason for this is that the merger will occur for accounting periods starting on or after our appointed date. So if you know that your year end happens to be the appointed date, it might be worth moving your year end back a month. By doing so, you can ensure that you're going to claim a slightly higher rate for another year. And if it's going to save you £30,000, then I think that might be worth it. So obviously we're going to have to wait for the confirmation of when they're going to bring this in, but certainly worth thinking about. So yeah, R&D certainly on the up, lots of activity from HMRC. We've seen lots of inquiries, which is good fees for us, but overall it's quite a good thing, because what HMRC are doing, they're going after the what we call ambulance chasers, to stop companies who really shouldn't be claiming this from claiming it. So I think overall it's a good push in the right direction, but what we are seeing as a result is there are some genuine R&D companies being caught in the crossfire. And I think this is really going to be there to stay. So we're seeing more requirements in terms of how we prepare these claims, which means I think we need to be having conversations with your R&D advisors much earlier. Now, this was actually announced yesterday or on Wednesday. Changes to creative sector reliefs, which I'm sure will apply to most people in this room. So there are reliefs for people who are creating films, children's television, animation, to provide tax reliefs for all. So if you're making something like Bluey, for anyone who's got children here, Bluey would be a great example of this if it was made in Britain, although I think the reality is we all know it's not children's TV, it's a parenting program that children like to watch. And what we're seeing is that this shift away from schemes that provide additional tax deductions to these expenditure focused schemes where you're given a tax credit for based on the percentage of your qualifying expenditure. I think the reason for this is that the UK are trying to comply with the OECD Pillar 2 requirements, which no one really understands that. Basically, there's going to be a global minimum tax requirement where effective tax rates have to try and come up. So if you move to an expenditure credit system, it has a quite funniness about it, where actually your effective tax rate is going to increase when you claim these. It just means that you're going to get some money back from HMRC. So it's sort of a bit of a win-win. So we have seen from the 1st of January this year that these various reliefs have been combined into the audio-visual tax credit and the video games tax credit. These will be compulsory for all new productions from the 1st of April 25, and by the time we get to the 1st of April 2027, the old systems will be completely abolished. Now, these provide quite generous tax credits for people who are working in this area, so 34 or 39% of your qualifying spend back from HMRC, depending on what scheme you're claiming under. If you think about that compared to R&D, where that's actually sitting at a 20% credit, it's quite a step up. So we've seen a few of our clients that actually do benefit from this. So it has huge implications for those who are doing this. I think it's very much a push in the right direction to try and help build this this area of our economy. We think that Pinewood Studios is a very crucial part, and we're always hearing in the news about new film studios opening up, and this is what's really helping to drive that. So this is really just covering off the inclusion or advancement of the audiovisual tax credit. So they are bringing in a new UK independent film credit with a credit equal to 53%. So you're going to get more than half your money back. So anyone who fancies just a bit of a side trade to what you're doing, why don't you go make a film? We've also seen expansion to bring in visual effects into the scope of what you can claim on, which I don't think that's really relevant to anybody. Anyone doing visual effects? No, I didn't think so. We've also seen confirmation of for the cultural sector tax relief. So this is things like orchestra relief, theatre relief. Now these schemes are a real lifeline for these industries coming out of the pandemic, who basically saw themselves having to shut up shop. So it's really encouraging to see that the government have realised that this was a good thing and then made this permanent, which is really excellent. So we do have quite a few of our clients actually benefiting from this, and it's been nice. It's been able to keep these productions going. So we see the Cambridge Arts Theatre doing very well job with this, and it's a real big boost to British culture. So long may that continue. So finally, moving on to the big announcement. PET. Normally they don't really mention it, but here we go. We're ready. They are increasing registration threshold from 1,000 to 9,000. Woohoo! So, as I said, not really much in the budget for us business tax people, but still, I think there's some things for us to consider. And we're hoping perhaps the next time around might have something a bit more interesting to talk to you about. But that covers off my part. I'm now going to hand you over to Stephen, who's got something far more interesting to talk about.
Thank you. Hello, everyone. Yeah, after that bombshell with the VAT thing, I have the pleasure of speaking about the non-dom change, which was, I think, the biggest change in the budget, the announcement. Not sure it was much of a surprise, but what the announcement actually unveiled was quite surprising. So before we talk about those changes, what I wanted to do is just give some context. What's the current regime? So then you can understand what the changes are. And then ultimately, what should people be doing ahead of those changes? So the current rules. Well, let's first of all talk about the remittance basis. What's it for? It's really to attract people to the UK, talent, wealth to the UK. And I think they view it as quite successful in doing that. And that's what essentially a non-dom is, someone with their roots overseas, to give it a shortcut to the definition. And the main benefit, which is shown in the table, is essentially whilst UK income and capital gains is always taxable, just as it is for a UK dom, it allows the non-dom to elect for the remittance basis, which essentially means their foreign income and capital gains can escape UK tax as long as they don't remit it to the UK. So if it comes to the UK indirectly or directly, then it's going to be taxed. But if they keep it offshore, then they don't have to pay UK tax on it. So that's in summary. A UK resident, a UK dom, like myself, I'm taxable on my worldwide income and capital gains. But a non-dom has the choice that they don't have to be. Their foreign income and gains can escape UK tax as long as they don't bring it to the UK. And the same for inheritance tax. There's an advantage that their scope of inheritance tax is just on UK assets. So their overseas assets, their wealth is outside of those for HT, which at 40% is quite high internationally. So that's a good attraction. So there has been changes over the years leading up to the new regime being introduced, and you'll see, hopefully, there's been a slow squeeze. So in 2008, that's when they introduced a charge to claim the remittance basis. It might seem odd, but before that, you didn't have to pay anything to claim the remittance basis. 2008, they introduced a charge. So effectively, in the first 7 years, you can claim it. There's no charge. You lose your personal allowance and annual capital gains tax exemption, but there's no charge. After that, in the 8th year, you'd have to pay 30,000 charge for the benefit of claiming remittance basis. And then they later introduced a 60,000 when you're here for 12 out of the previous 14 tax years. And then it only lasted a couple of years, but there was even a 90,000 charge. And that was just a year's charge just to claim a remittance basis. So most people typically only claim the remittance basis in the first 7 years. After that, it just depends on your wealth overseas. So the more wealth you had overseas, the more people would pay it. It made sense. But importantly, also brought in stricter rules about what is a remittance, and then also tracing income and capital gains. So if you earned interest and then you reinvested that interest didn't get lost, you effectively traced it into the new asset and then back again into the account. So it's quite complicated, but that's when it was introduced. And then in 2017, they made further changes. And I think the key thing is 2008, they introduced a charge. 2017, they introduced a time limit is the best way to think about it. Because before, in theory, it could be unlimited. As long as you stayed non-dom, you could keep clear the remittance basis. So this was a big change in 2017, that essentially, once you'd spent 15 of the previous 20 tax years as a UK resident, you didn't access the remittance basis. So it's quite a big change. So they did allow rebasing, and they also allowed where people had set up offshore trusts more for an IHT advantage, that they, because they can access a remittance basis, they allowed it as long as a settler who benefited from the trust, as long as they didn't taint it, effectively, it was like a money box. They only got taxed if they took funds out of the trust. And then they also introduced a concept for formerly domiciled residents, and effectively that was looking to stop people who are UK domiciled going overseas, saying that they'd changed their domicile status, coming back to the UK. Essentially, for UK tax purposes, they'd look through that. So it was there's a famous case on it. So that's why they put that into the rules. So if it's been successful and it's attracted talent, why change it? Well, hopefully, as you gathered, it's very complicated. And the big thrust of it was people paying the remittance basis, then don't bring the funds into the UK, because if you bring the funds into the UK that are sheltered from UK tax, you pay tax of it. So it encouraged people to put keep their funds offshore rather than bring it into the UK, which seems quite strange, really, if you think about it. And domicile itself is very complicated. So it's about intentions. So someone could be here for 40 years and still may be considered non-dom. So it's complicated. So that's why they're looking to change it. And also politically, it's a cost of living crisis. The non-doms are viewed as being quite wealthy, everyone paying their fair share. So politically, there was a greater focus on it. So the new regime. So the key points is that it's becoming much simpler. It's a residence-based test rather than a sort of domicile, which is intention, which is quite vague. So that's the improvement. They're very pleased with the statutory residence test, the clarity it provides. So that's why they've looked to move it to a residence-based system. And it's much simpler in the sense that it gives an exemption rather than having to worry about where the funds are. It gives an exemption, so there's no issues on that. And they are giving transitional rules to try and soften the impact for those that no longer benefit from a remittance basis. So, as I said, it's a residence-based test, and what they're looking at is really to aim it at people who have no connection to the UK, or if they have, it's been some time ago. So you need a clear run of 10 years of being non-resident, and once you meet those conditions, you can have 4 years of this favourable regime. And how is it favourable? Well, your foreign income gains in those 4 years, you can elect for them to be exempt from UK tax. You don't have to worry about keeping those offshore. You can bring those to the UK. So it's a much simpler system in place. If you elect for this, you do lose your personal allowance and your capital gains annual exemption. So it's much like the remittance basis currently. There's no change on there. And you still have access to the overseas workday relief if that's what you're interested in. But that only stays for 3 years. There's no extension to that. But the feeling is that should be much easier because you don't have to worry about accidentally remitting your overseas, the element that related to overseas workdays. The trust protections that I mentioned earlier, they're lost, but in those 4 years, you won't be taxed on that. So it does seem a much cleaner, easier system. The cost of this cleaner and easier system is that it's only for 4 years, whereas most people would have claimed remittance base for at least 7 years. So who's going to benefit from this new system? Well, those that are resident in the UK in the previous tax year, that's 22-23, this tax year and later. Although if you're a resident in the previous tax year or this tax year, you're not going to get the full benefit. So it's a case that you'd probably be on the remittance basis and then switch to this new regime. And that may sort of affect what you do. Do you accelerate income in a remittance basis years, or do you try income and gains, or try and wait till you're in the new regime where actually there may be exemptions. As they say, there's transitional provisions because they don't want people to sort of suddenly leave the UK. The idea is to attract talent. So if you don't qualify and you would have otherwise paid a remittance basis, you've got 1 year where 50% of your foreign income will be free of tax. That doesn't apply to capital gains tax, but you do get the ability to rebase. If you held the asset personally, 5th of April 2019, you get the market value at that date. Don't ask me why it's 5th of April 2019. I don't actually know, and there doesn't seem to be much logic for that, but that's how it works. And then there's a wider sort of provision, and that looks to encourage people to bring their wealth into the UK. As I say, under the remittance basis, we do a lot of advising people not to bring funds into the UK, where actually then there's going to be a 2-year window where if you bring funds into the UK that have previously been sheltered because of the remittance basis, your foreign income and capital gains, then they're going to be taxed at a flat rate of 12%, which can seem quite advantageous. So it's whether you claim the remittance basis if you can, and then bring those funds in at a much lower rate. If you do miss that window, though, they're going to be taxed at the normal income tax and capital gains tax rates. So it's essentially, if you can take advantage of it, probably wise to. But of course, it's always the devil is in the detail. So we'll have to see what those provisions actually mean, what the conditions are. And then inheritance tax, which I touched on at the start. So before April 2017, there was a concept of deemed domicile for IHT, 17 out of the previous 20 tax years, and you're within the IHT scope of IHT. So what a lot of non-doms would do before that date, they would create an offshore trust, because even if their domicile changed, the assets within the offshore trust, as long as they set it up when they're a non-dom, that would be outside the scope of inheritance tax, provided the trust didn't hold any UK assets. So it's quite a valuable thing. Following the 2017 changes, not much changed. The deemed domicile applied from 15 out of the previous 20 years. That applied for income tax and capital gains tax. They put that deemed domicile concept all together. But again, non-doms would create a trust before that date and protect their wealth from inheritance tax. But they're looking to move the consultations that inheritance tax is based on your domicile position, always has been. So they're looking to move that to the residence-based sort of test. It's much clearer, much simpler, and for the revenue will be much simpler for them to attack if anyone has fallen foul of those rules. Whereas at the moment, it's very vague. As I say, domicile is based on intention and your circumstances, so it's not a clear cut. A residence-based system is much cleaner. What they're looking at is the consultation, so it is just ideas at this moment. They're looking at if you've been resident for 10 years, you're within the IHT tax net. But what actually is probably worse, in my respect, is there's an identical IHT tail. And what do I mean by that? I mean, if you're in the scope of inheritance tax, it will take you 10 years of non-residence to fall outside of that. So that's quite steep, in my opinion. Currently, the worst case it would be is 6 years, 6-year tail. So that's something to look at. Trusts, whether they're still a good shelter, who will know? But they have confirmed that if a non-dom sets up an offshore trust in the next tax year, so before this new regime, so by 5th of April 2025, then it will still be in the current regime. So those that can protect their wealth from inheritance tax, which a lot of non-doms are very interested in because the rate is at 40% IHT, then essentially you're best to do that before the new regime. So what to do? Well, there's probably quite a lot to do, but as I say, it's devil's in the detail. But if you're a non-dom, I suggest that you look to confirm your non-dom position. Make sure you get a domicile statement, because the transitional provisions rely on you being a non-dom. So it's worthwhile doing that, especially if you're looking to set up an offshore trust to protect your IHT. That relies you're being a non-dom. If you're deemed dom, UK dom, then you're not going to save IHT. You're going to create an IHT tax charge, and sort of, it will be far worse than you imagine. So it's best to get a domicile review. We can obviously help with that and help you with a domicile statement. But it's also important because where I mentioned there was rebasing provisions in 2017, it's only sort of recently that the revenue started inquiring into those to confirm if you get it or not. So it's not an instant response. So it's better to get that domicile statement now, have everything ready. So if there is an inquiry, you can respond really, really quickly and not have to sort of scrabble around and try and prove what your intentions were in at the present day. So it's always hard to go back. It's much better to get it done at the time. And then all non-doms, it's essentially review your plans. If you're going to be in the UK for a short term, that may change your how you feel about these changes. If you're in here for the long term, then you're going to try and do things in between before the new rules are introduced to try and mitigate the impact. And there's lots you can do, lots of decisions. There's not a one size fits all. It's going to depend on your circumstances. Do you accelerate income or capital gains? Do you delay them for the transitional provisions? There's not an easy answer, but it's really important that you try and devise a strategy. And with that, take time. Don't do knee-jerk reactions. That's always bad. Have considered approach, but use the time wisely. And importantly, obtain advice. And that's not just tax advice, but it'll probably be investment advice as well, and probably legal. So it's really important that you use that time wisely. It will come around quickly, but act before it's too late. And then, sadly, other changes, but this is a sort of a transfer of assets abroad. So it's a really sort of complex anti-avoidance provisions. And essentially what they look to do is to prevent someone transferring assets. So the income arises to a non-resident to avoid UK tax. Effectively, they look through it. There was a recent court case that the revenue lost because the transferer, they couldn't, onto the individual, it was the company that did it. So it meant that it was outside the rules. They've changed that now. So they've widened it. So if a company makes a transfer, then it was deemed to be the shareholder. So it's a wider aspect to it. Just something to be aware of if you're looking at setting up offshore structures, just to be aware that they've widened it. And that will have quite an impact, I think. So there we are. That's the end of it. And I'll happily pass to Sanchez. We'll take you through the rest of the personal tax.
Thank you, Stephen. Good morning, everybody. It's lovely to see so many familiar faces, not to mention a few new ones. My job here today is to talk about the rest of personal tax, and as Stephen's taken most of it, you'd think I'd have nothing to say, but you know me, I can always fill 20 minutes, so it's not worried about that, but plenty to talk about. There's been a lot of talk about making some permanent changes. Of course, the Chancellor can't make a permanent change because he doesn't have a permanent position as a Chancellor. So the next few years are going to be very interesting indeed. Today, we're going to look at three things. So the impact of changing thresholds and allowances and how that impacts on us as individuals. Because frankly, for me, that's what the budget is all about. I know I don't do corporate tax and I'm not a non-dom. So I'm really interested in, am I going to be impacted? And I imagine you are as well. What do these changes mean to us? We're going to have a little talk about profit extraction, only a little talk, because we did a long one last year. And we're going to talk about some changes affecting property. And there were three quite significant changes here, and we need to understand the balance of what they mean for us. So without further ado, and not spending very much time on this, there was a 25% increase on the amount you can put into your ISA, but it's not into your usual ISA, it's into a brand new British ISA. Further information to come in due course. There was quite a lack of detail that I would say for this whole budget. It's actually very interesting considering they've got a plan. We know all about it. Income tax, we were talking about fiscal drag earlier today. This is where we as individuals really see this. The allowances haven't changed, the thresholds haven't changed, but real income, of course, is going up, hopefully to keep in line with inflation. So there is a negative there, it's a fiscal drag. And then they've reduced the tax-free dividend allowance from 1,000 to 500. We knew that was coming. I expect it will go back to zero fairly soon, but that's the cynic in me. Child benefits. This is a very interesting point, and I know is very dear to some hearts in the house here today. It's a very unfair regime. So you're entitled to have child benefit if you have a child, but if you earn too much money, they start to claw it back, and then eventually you get none at all if your income is too high. It is really unfair because it is at the moment looking only at the highest earner, which means some people who have one working parent who earn a lot of money don't get any child benefit at all, whereas you could have two working parents who are just under the limit, so earning a great deal more than your high earner, and they get the whole benefit. So they are looking at this, they know it's not right, and they've said, well, we're going to tweak it this year, we're going to increase the earnings limit. So previously, if you earned 50,000 or more, they start to take it away. That's now going to be 60,000, and the top limit is going to move up from 60 to 80. So the tapering mitigation is less, and hopefully most people can keep a little bit more in their pocket. But going forward, they're acknowledging that's not right, that's not fair, and not before 6th of April 25, but without, again, we haven't got a date when they're going to present it. It's going to be based on your household income. Now, some of you are as old as me and can probably remember bringing in independent taxation. Previous to independent taxation, everything was taxed on the household. So that's going to be very interesting. They haven't said, because they don't really know yet, what's going to happen with that, or how the thresholds are going to happen, or how it's going to work. So it won't be before April 25, probably won't be that soon. Pensions, they didn't mention this at all, so I'm hardly going to say anything. There were no changes, the allowances remain the same. But what I would remind you, and perhaps it's a good time to have a chat with your IFA, is those of you who have reached what used to be previously a lifetime allowance, that was abolished. So you can top up a pension that you thought was frozen forever. So if your pension pot has reached that point, the limit has been removed and you can now add in, which is quite unexpected. I don't know how many people have taken advice for that, but it's something I think is going to have a limited opportunity, particularly if we have a change of government. Capital gains tax, there's a red arrow and a green arrow. The annual exemption is going down, that's bad. The higher rates of capital gains tax on residential property is also going down, and that's good. And we're going to talk about it a little bit more in detail later. National insurance, Matthew's stolen my thunder, obviously. It always happens, doesn't it? Whoever does the introduction takes my big point and talks about it. So in recent months, we've seen national insurance drop from 12 to 10%, and it's going to drop to 8%. 4% reduction. It feels very exciting, doesn't it? It feels as though we should feel that in our pocket. Apparently, it's £900. If you take those two things together, you're supposed to feel as though you have £900 more in your pocket. It's not quite so generous as self-employed. That's wrong. I'll say that again. It's just as generous as self-employed. It's going down to 6%, which is also better than employees, and that's going to have perhaps other unexpected impacts later on. But for employers, those of us who are running businesses and paying our employees, there's been no change. We're still paying 13.8%. So that feels now really expensive in comparison to everything else. The government said this is a double taxation that they are charging us. That's quite unusual for them to say we're charging the price. And their ambition is to stop charging us a price. But we're not sure how practical that is because there are other things that hinge on our national insurance contributions. I'm taking this very personally because I suspect it's the first step on a slippery slope to say, Sanctuary, you can't have a state pension when you retire. Because if you're not making national insurance contributions, how will you create enough benefits for your state pension down the road? So that's very disappointing to me. They haven't said that yet. That's my prediction for when I get to retirement. Is it practical? There are other issues as well. So there are lots of cross-border issues about national insurance. So Kate, who's smiling at me because she knows I don't like talking about this. We've had lots of issues with workers who are working in different legislative countries, different regimes. How is that going to work? Again, we have absolutely no idea. So I feel very comfortable talking about it. We have absolutely no idea how it's going to work. They haven't given us enough detail just yet. So going back to the national insurance point I was making just now, we've got a differential between self-employed national insurance and a differential between employed insurance. So what does that mean to us? If we're running a business, how should we structure our business? How should we take our profits out of that business? Now, we have talked about this on a number of occasions and the rules aren't completely different, but I thought it was worth putting a picture up rather than a table. So let's go for it. So this is a graph which is showing the money that you can keep in your pocket. That's what's going up the side here. The cash that you can have in your pocket to keep after all taxes have been paid on the profits that are shown at the bottom. So if your business is making £50,000 worth of profit, does it matter if you're corporate or self-employed? The corporate lines are the bonus and dividend lines, the blue and pink lines, and the self-employed is the purple line. The purple line is slightly higher, but it's really marginal. So should you be self-employed? Should you be running through a limited company? It's really tight at that point. It doesn't make very much difference. As you move forward, you've got £100,000 worth of profits. You can actually see those lines are separated. So the blue and the pink lines, have you structured your remuneration policy correctly? Are you just taking your salary out as PAYE, or have you taken some advice? And are you having a basic salary and then topping up with dividend because the rate of tax is slightly lower? Or do you want to be self-employed because you get more in your pocket? And when you get to £250,000, there's a greater divergence. It looks really generous on there, but actually financially it's not huge. And of course, tax never, ever, ever is the tail that wags the dog. We always structure our business for commercial reasons. What is right for you? Do you need to be a limited company? And by the time you get to £250,000 worth of profit, most business owners are reinvesting their profits in their business for future growth. And at that point, you're not taking everything out. So this chart, whilst it says, oh yes, you should definitely be self-employed, is actually a bit misleading, because if you take everything out, you might be better off. It doesn't address the commercial reasons why you might be in the corporate structure. You would perhaps feel a lot more comfortable in the corporate structure, and it gives you the opportunity to reinvest your profits and pay lower taxes. So whilst this chart suggests you probably should be self-employed, I suspect the reality is not going to be so. So the final topic I'm going to cover today is property. And there are three different types of property changes that we want to talk about. The first is stamp duty land tax, second is capital gains tax, and then the furnished holiday letting losers. I've seen it described today. I quite like that. I'm taking that one quite personally. So let's start with stamp duty land tax. Now, the first thing about stamp duty land tax is it is a tax on the purchase of a property. So normally we're taxing something at the end of a transaction when you've had something and you're disposing it. But this is at the opposite end. So stamp duty land tax is paid on the acquisition of a property. And the relief they are taking away is multiple dwelling relief. So what is that? For those of you who don't know, if you were to buy a property that has 2 dwellings or more in it, so for example, a house with a granny flat, or a landed estate with a couple of cottages in the garden. When you buy 2 dwellings together, you can elect for them to be treated as two separate purchases. And you don't do that on a real basis from cost perspective, you do it on an average basis. So you say, I've got two properties, the purchase price is £1 million, I'll divide it by 2, I'll deem each one to cost £500,000, and I'll calculate the stamp duty land tax on that. So it's an average price. It means you're using lower rates of stamp duty land tax. Does that really matter? Well, the answer is yes, it does. So let's consider my clients are in the process of buying a new home. The house is a large house. It has a self-contained cottage. It doesn't matter if it's a small house with a little granny annex. The numbers will be different, but the situation is the same. In this case, we're going to spend 2 million on it because that makes the averaging easy for someone who's standing up front and don't get it wrong. So we're buying a new house. In this case, let's say we haven't exchanged yet. Let's say we haven't exchanged yet. We haven't completed yet. This date applies to completion. So you have to complete before this comes in. So by the 31st of May. Because if you don't, the results could affect your finances quite significantly. So let's have a look. So this is a purchase for £2 million with multiple dwelling relief. We tax it, and the stamp duty land tax is calculated on £1 million purchase times 2. So taking each property separately, you can see at the bottom of the first column, £41,250 each property, total stamp duty land tax is £83,500. Take away your multiple dwelling relief. What happens is you tax the 2 million and you've got acquisitions falling into this highest band of tax at the bottom. And that basically means you're paying an extra £68,000 worth of tax and £750. So it's a real cliff edge. If you complete on the 31st of May, you'll pay £82,500 stamp duty land tax. If you complete on the 1st of June, you're going to pay £68,000 more. So I'm guessing conveyancing colleagues who are amongst us, or probably even aren't here because they're so busy sitting at their desks, they're going to have a very busy few months. So what should they do? They should definitely complete before the 1st of June. If you have multiple dwellings, and it happens more often than you might imagine, please complete before the 1st of June or change your financial structuring, because that extra 68 grand is not something I could find out of my pocket every day. There is a slight exemption. If you have already exchanged contracts before budget day, it doesn't actually matter when you complete, you will still, at the moment, qualify for multiple dwellings relief. But that's on the assumption you make no changes whatsoever to your contract. So if you've entered into contract, you've exchanged contracts, you should be all right, but don't change it in any way at all, or you will be caught by this. What happens if you can't get this? Well, if you're buying 6 properties or more, there is an opportunity to say it's non-residential, because let's face it, how many of us need to live in 6 houses at once? So they can look at that and say it's non-residential. The moment you can elect, do you want to have multiple dwellings relief or do you want to be non-residential? Whichever is better for you. Going forward, that is one of the limited options. And the other option will be looking and saying, well, am I buying a property and has it got mixed use? Is it partly business? Is it partly residential? And if you've got any of those issues and you've got any doubts at all, please talk to our stamp duty land tax specialist. I'm not sure if they're here today, but either Sarah or Jude, who will be absolutely delighted to help you and your clients with that. So the next change was to do with capital gains tax, and you'll have to indulge me for a moment because I thought we might as well use the same slide for a second time. So the annual exemption is going down. This year it's £6,000. Next year it's £3,000. That's not usually good news. If you're selling a property, however, and you pay a higher rate capital gains tax, it's going down from 28 to 24. That is excellent news. So you're about to sell a property and you think, oh, there's been a change. When shall I sell it? Shall I sell it this year? Shall I sell it next year? Well, obviously, You're going to sell it which side of April? So who thinks this side of April? Nobody. Okay, excellent. Everybody thinks it should be next April, but what if the taxes and gain is small? What if that loss of £3,000 annual exemption is worth more to you than the reduction in high rates of tax? What if you're not a higher rate taxpayer? It doesn't impact you at all if you don't go into higher gains tax. So in this particular slide, because the taxable gain, so you might be selling your house, it's mostly covered by main residence relief, but there's a little bit that's going to be taxable for one reason or another. The taxable gain is over 20,000, you get your 6,000 annual exemption, the taxable gain is 14, and even if you were a higher rate taxpayer, the tax would be 3,920. Next year, it would be 4,080 because you don't get the annual exemption at the same level. Those numbers are quite small and you're like, do I worry about it? Maybe not, but to some people, that's more valuable. So it's also worth looking at which year is my gain going to be in. Now, because we've simplified the system, obviously, this is a completely different set of rules from stamp duty land tax. Stamp duty land tax, it's all about completion. Capital gains tax is all about exchange dates. So two completely different sets of dates you need to think about if you're disposing of a property. So, furnished holiday lets and visas. You can hear I'm sad about this, can't you? What does it really mean? Well, for me, what is a furnished holiday let? It's obviously a property that you let out for people to use as holiday. Why do we care about it? We care about it because for tax purposes, if you let out a property and it meets all the criteria, and there are a lot of criteria, it's treated as a business. It's not an investment. And you know, for tax reasons, those two things have completely different impacts. If it's a business, you get different reliefs. If it's an investment, much less generous. So from April 25, this is gone. It's going to be completely abolished. There will be some transitional rules. We have no idea what they're going to be. But what does it mean for you? What does it really mean? So for capital gains tax purposes, it's a business. So when you dispose of your business, you'll be eligible for business reliefs, perhaps a reduced rate of capital gains tax. I have to say, it's been quite difficult to achieve the reliefs on disposal of those. So I suspect that loss will not be so widely felt. But the income tax position is quite penal now. So you're joining the normal residential rates. You will lose your income tax relief. You will no longer get relief for your mortgage interest fully. Talk about that in a second. You won't get release of capital allowances, and your profits will no longer be treated as earnings for pension. Now, some people have their business is running holiday lets, so they'll no longer have any earnings for pensions going forward. So that's quite a worry as well. But really, it's looking at it and saying, what is the impact? So let's say we've got a property, it lets really well, £50,000 worth of profit, net, that's sort of net profit after most of your expenses. I've just stripped out the capital expenditure and mortgage interest. You have to pay those things. I just want to remind you, the fact that they're missing from the second column doesn't mean to say they've not been paid. So in the current year, you've had your income, £50,000, you've got a capital expenditure of 5, you've got mortgage interest that you have paid of 10, so your taxable profit is 35, your tax due is 14. Your take home is 21, because that's what we're interested in, isn't it? The rules change. After April 25, you no longer get that restriction, a deduction for capital expenditure, and you definitely don't get mortgage interest. So suddenly you're paying tax on the whole of your profit of £50,000. You can have a little bit of tax credit later for your mortgage interest. You get the relief at 20% only. So effectively your tax goes up and your take home goes down. Now, if you have a number of these properties and they're all mortgaged, this could have a really significant impact on your business. If you're not mortgaged, you probably don't care so much. So I think what actions should you take? You need to understand the finances. You need to understand how this is going to impact on you if you have these properties. Is it even viable to keep it going forward? Because at some point you might find that your cash flow means that the tax is so high, there's nothing to go in your pocket at the end of the day. If you're thinking already before this that you might want to dispose of your property, I would recommend moving that on and disposing of it as soon as you can. The purpose of bringing this in, apart from paying for that national insurance reduction, is to create a flow of properties. And I think this is very misguided myself, because yes, there is definitely a shortfall of properties, and quite often in nice UK tourist places there's a shortfall, but the value of these properties, in my opinion, is generally not going to suggest they're going to be available to first-time buyers, unless we're going to create a property crash in all seaside towns across the country, and then you'll have even more unhappy people. So let's see where this goes. So I think the summary of today is that it was quite a quiet budget. We've definitely got simplification in the best arrangement and definition of those terms, because the government using simplification creates a whole load of work for us. So we're delighted with that. As Angus said, there are some actions you need to think about in the corporate world. Should you shorten your accounting year? Should you look at your R&D, particularly for the R&D intensive businesses? Are you entitled to creative or cultural reliefs? And a few people were definitely making notes. So they will people to talk to you afterwards, don't worry. Are you a non-dom? Have you got non-dom clients? There's a significant amount of planning. Please talk to Stephen or my other colleagues who specialise in the non-res and the domicile issues. If you have a normal business, do you need to look at your extraction policy for remuneration? Should you have a bonus? Should you have a dividend? Is it right in the first place? It's always good to say, is what I've got fit for purpose? Let's have a quick review. Look at your trading status. If you're about to set up a new business, should you be self-employed? Should you be employed? Talk to us. Of course, it's quite fluid. You can move happily from self-employment and incorporate. So that might be another option that's available. But all of this is talking to us and getting a bespoke solution for you. And of course, if you are a furnished holiday letting loser, do come and talk to me and we'll consult together. So thank you for your kind attendance on us today. I'm going to hand over to Mike now in case anybody's got any questions that they want to ask, and then I will come back and close.
Thank you very much, Sandra, and thank you, Stephen and Angus. That's a really informative presentation. So we have the Slido open. There's a few questions come in, but if anyone's got anything they want to ask, I have to go around the microphone and take some questions. So first one for Stephen, I think. Do you think the non-dom changes have gone far enough for Labour, or should we expect more changes if there is a change in government?
I think actually it's pretty much in line with what probably Labour are going to do. I can't imagine that there's going to be too many tweaks. From what I understand, Labour was looking at 4 years. That's what they've given them with their plan. So I can't see it happening. Essentially, probably what will happen if Labour do get in government, they'll probably let it go in as it is, but probably tweak it. But I think actually it's getting to what they want. It's a simple system. It's 4 years after that, everyone is taxed and all the earnings and gains. The interesting input Labour will have is on the IHT, because that's a consultation. So that's when they'll have a real sort of thinking on it. So yeah, I don't suspect there's going to be income tax and capital gains tax much change, to be honest.
Thank you, Steve. Angus, a little technical one for you, which you may or may not be asked to. Can the audiovisual tax credits be applied to technical training videos produced in-house?
So in theory, it's all about, I think, British test here, so it's be Britain. So to qualify for these, you have to be able to apply for a certificate from the British Film Institute to confirm that actually this is the benefit of Britain. So my initial thoughts would be, well, probably not, unless you can demonstrate that sort of your training video is going to be really, for the benefit of the broadcast across Britain, that's how interesting the content is. My initial thought would be probably not, but Rachel, our specialist in this area, we're more than happy to answer further questions.
So, Sancha, is the new taxation of furnished holiday lets now the same as long-term rented property income?
The answer is almost certainly yes, it's going to be. We don't know how we're going to move into it. It's going to be a transition. We don't know what the transition is are, but I think that is the purpose. There will be no differentiation from the tax perspective between the two types of property renting. And I think it is the government are hoping to drive longer term lettings rather than short term lettings.
Thank you. Just sticking with you at the moment, actually, did you say that some people will reach a point where tax due on a holiday let could be more than the spendable income?
I think they could definitely get to a point where the tax they're paying moves them into a deficit, so they have no spending cash left, and they might have to look to fund the tax from elsewhere. And that's where I was saying we need to look at the viability. Is that business a viable business going forward?
Yeah, that makes sense. If you don't get the reliefs, you get some to spend. Stephen, there's one for you. It's quite broad, but does this spell the end for offshore trusts?
I don't think so. I think there'll be a rush for offshore trusts in the next tax year, if I'm honest. And it's a sort of a wait and see, in respect of what they do with the consultation. But I don't think so. In essence, the option is you only have an offshore trust, even if there's a set benefit from it, with no worse position in income tax and capital gains. Because if you hold on to those assets personally, you're going to be taxed on them. Within a trust, you're going to be taxed on them, but you'll get that IHT advantage. And the government being quite clear in that if you set up the trust before the new regime comes in, you'll get that IHT protection. So I think there'll probably be an influx of work. So with that in mind, the earlier you get set up, the better, because it's not quick. You can't do it in a couple of days. So I think there'll be that. Yeah, I think it'll still be interesting for the offshore trust regime. Some will probably look at lapse, but again, it's the level of wealth that you have. How viable is it? Because offshore trusts do have ongoing costs, the administration.
Okay. So I think we'll stick with you actually, Stephen. There's quite a lot of interest in non-doms on this one. So thanks. So now the Tories have shot Labour's fox, so non-dom tax.
Yeah.
What small tax increase do you think that Labour will come up with next?
Been wide as well, not just on the main grounds. And so clearly there was a political motive to stop Labour keep going on about how much the 2.7 billion whatever that they keep promising and spend. I think it's 10 or 20 policies that they were using to fund. So the Tories have felt that to fund the tax cuts. But yeah, I'm not sure. I don't know if anyone else has got comments on.
Well, they don't know yet. They've got plans.
Oh yeah, that's true.
So I think that's time for now. So I'd like Sanj just to summarise and finish up.
Thanks, Mike, and thank you for all your questions. Obviously, if we haven't asked your questions today, I'm going to skip a slide forward. This is our tax team. You saw them earlier, but they're very happy to take any questions that you have either today or do contact them. The usual contact on the usual numbers or the usual email addresses. So we go from there. It's been a very interesting couple of days. We have learned, as we've discussed, that Labour don't have a financial plan, and what they did has been stolen by Conservatives. Conservatives definitely do have one, but they haven't really shared it, which is why we haven't really felt there's been a particular flow today to the presentation we've given. There've been lots of pockets of unrelated discussion. Paul Matthew had absolutely nothing to talk about, but that was great because he was able to step in for Warren, who is at the pre-arranged Crescent conference. But we've tried to share with you the areas of the budget which we think impact on you and our wider Cambridge community. and we hope you have found the presentation informative. It's a budget for long-term growth. It's a budget for permanence. There were no giveaways for a pre-election budget. You would normally expect to see that. As Matthew was saying earlier, what does that mean? Does that mean there'll be a delay in election? Does that mean to say we're going to have another mini budget later in the year when hopefully the finances look a little better? As usual, it's let's wait and see. So there's no surprise there. I want to thank you for coming today and being such a good audience participating with us. We hope you found the insights enlightening. And as I said earlier, we can chat with you if you wish to discuss anything specifically further. My colleagues who are all up here, we have a huge diversity of experience and are able to cover virtually anything that you ask us. Somebody will know the answer because they've had that experience before. I also want to put a huge thank you to all the team that you don't necessarily see for their hard work in making this happen. It is not a four-person show. All the team are assisting in pulling this information together, and we just take the glory. So thank you. You know who you are. Thank you. Appreciate it. And particularly Angus and Stephen, who stepped up today. Jan wasn't expecting to be here, and Stephen didn't know until he was sitting there and there was a huge non-dom announcement, and I said, oh, well, as Matthew hasn't got anything to say, I think perhaps let's bring somebody else in. So really it was a very last minute decision for Stephen, so thank you both of you very much indeed. It's been really nice perhaps for you to see some new faces up here, some of our expertise from our other teams, and it's great to have that diversity so that if there is a new issue, we can pull them up and say, please come and talk to our contacts about this. So having new people at the lectern is always interesting. Perhaps next year it's my turn to step back, but we'll see. Now, the next part of this, I was going to beg some indulgence because as well as welcoming new faces to PEM, we have somebody who's reached a milestone and is retiring. But it turns out he might have retired before I knew it because he hasn't turned up today. So I'm going to show you the embarrassing photos anyway. Stephen has been a huge part of PEM for a really long time. He joined in 1989. He's been a partner in audit and accounts since 2001, and he's retiring a deserved retirement. I've always said he's a little bit like a stick of rock. You cut him in the middle and you'll see PEM inscribed on the inside. You know, he's got PEM at his heart. I was going to do a nice big thank you to Stephen and go into all the things he's done, but he's not here to hear it. So on that basis, I really think we're really going to miss him. We, as PEM, have got lots of opportunities to say goodbye for the rest of the month, but we just wanted to share with you that he's going. He's been a big part of your lives and our lives, and he will be sorely missed. But I am going to not do the rest of the speech because he's not here to hear it. So thank you everybody for coming. I really appreciate it. Hope you've enjoyed the morning. Somehow we seem to have gone to 10:15 really. Thank you very much and see you next time.